Hello, I'm Jasri Tesea, and I'm excited to present Group 2, who will be reporting cost volume analysis. With me are Mr. Marlon Lim, Mr. Kevin Narciso, Mr. Sai Hover, and Mr. Roya Tapala. Cost volume analysis is a crucial tool in business management, helping us understand the relationship between cost, volume, and profitability. As we delve into this topic, we hope to provide insightful analysis and valuable insights that will aid in decision making and strategic planning. We are excited to share our findings with you and look forward to engaging in meaningful discussions. Chapter 3 focuses on the relationship between the volume of activity, costs, and profits. It emphasizes the importance of distinguishing between fixed costs, which remain constant regardless of activity level, and variable costs, which change in direct proportion to activity. Understanding these relationships help in making short-term decisions and assessing business risk. The chapter builds on the concepts introduced earlier in Chapter 2 regarding relevant costs, extending the analysis to include how fixed costs can sometimes be irrelevant for decision making purposes. The learning outcomes listed aim to equip readers with skills to analyze cost behaviors, prepare break even charts, understand the weaknesses of break even analysis, and apply marginal analysis in practical scenarios. Strategic Decision Insights. Cost Volume Profit or CVP analysis provides vital insights for strategic decision making by elucidating how changes in production volume, costs, and selling prices influence profitability. It helps managers identify the break even point, which determines the minimum sales volume needed to avoid losses and assess the impact of various scenarios on profit margins. Key strategic decision insights derived from CVP analysis include: first, pricing strategies. Understanding contribution margin enables firms to set optimal prices, particularly when considering market competition and demand elasticity. Second, product line decisions. By analyzing the profitability or different products or services, managers can decide which offerings to expand, reduce, or discontinue. Third, cost management. CVP emphasizes the importance of controlling fixed and variable costs. Identifying cost behaviors allows managers to strategize cost reductions or structural adjustments to improve profit margins. Fourth, profit planning. CVP facilitates scenario analysis, evaluating how changes in sales volumes, prices, or cost affect profits, thus supporting long-term strategic planning. Fifth, operational flexibility. Recognizing the contribution per unit and contribution margin ratio helps in optimizing resource allocation, such as maximizing contribution from limited capacity or scarce resources. Sixth, product mix optimization. For multi-product environments, CVP analysis assists in determining the most profitable combinations, especially under capacity constraints, to maximize overall profitability. The last one is risk assessment, as it highlights the levels of activity that pose higher risk, guiding strategies to mitigate potential losses or leverage profit opportunities. Overall, CVP analysis serves as a critical tool that aids managers in making informed, data driven strategic decisions, aligning operational activities with long term organizational objectives, while accounting for the inherent trade offs and uncertainties in business environments. What is cost behavior? Cost behavior refers to how different types of costs change in response to variations in the level of activity within a business. It categorizes costs based on the response to activity changes into fixed costs and variable costs. Fixed costs remain constant irrespective of the level of activity. They are incurred even when there is no output or sales, such as rent, salaries of management, or insurance. Variable costs change directly in proportion to the level of activity or output. Examples include raw materials, direct labor costs, and commissions. Understanding cost behavior is essential for analyzing how costs will impact profits at different levels of activity and making informed short term managerial decisions such as pricing, budgeting, and cost control. For the next slide, I'll turn over the presentation to Mr. Kevin Narciso. Thank you.
I'm Mark Kevin and Narciso, and I will report fixed and variable cost. Fixed cost is a type of cost that remains constant regardless of the level of activity or production volume within the relevant range. These costs do not vary with changes in output or sales in the short term. Examples include rent, insurance, salaries of permanent staff, and depreciation on machinery. Fixed costs are incurred regardless of whether a business is operating at full capacity or shut down, although they can change over different time periods or if the business expands beyond its relevant range. On the other hand, variable cost is a type of cost that varies directly in proportion to the level of activity or production volume. As output increases, total variable costs increase. Conversely, they decrease when output decreases. Examples include raw materials, direct labor costs tied to production, and utility costs that fluctuate with usage, such as power for equipment. At zero activity, variable costs are zero, and they rise steadily as activity expands. Fixed cost computation involves identifying costs that do not change with the level of activity within the relevant range. To calculate fixed costs, especially when they are not directly observable, one common method is the high-low technique. First, select the periods with the highest and lowest levels of activity. Second, note the total cost associated with these periods. Third, calculate the variable cost per unit using the difference in total costs divided by the difference in activity levels. And lastly, determine the fixed cost by subtracting total variable costs from total costs at either high or low activity point. Variable cost computation involves determining the cost that varies directly with the level of activity or output. The typical approach includes data collection, identify high and low activity levels, calculate variable cost per unit, and determine the total variable cost at any activity level. In data collection, you gather total cost data at different activity levels, such as quarterly electricity costs at varying output volumes. In identifying the high and low activity levels, select the periods with the highest and lower levels of activity and note their total costs. To calculate the variable cost per unit, use the difference in total costs and activity levels for these periods. And lastly, to determine the total variable cost at any activity level, you have to multiply the variable cost per unit by the activity level. For example, based on the electricity cost data, to get the variable cost per unit, get the difference in total cost using the given figures. The total cost is 40,000 pesos, then divide it by the difference in activity levels, which is 80,000 units. So, the variable cost per unit is 50 cents. Next, to get the fixed cost, first, multiply the variable cost per unit, which is 50 cents, by using the lowest activity level, which is 100,000 units, and we will get 50,000 pesos. Now, subtract the total cost of the lowest activity level, which is 80,000 pesos, from the total valuable cost per unit, which is 50,000 pesos, equals 30,000 pesos, which is the fixed cost. Understanding the distinction between fixed and variable costs helps managers estimate how costs will behave with changes in activity levels and aids in decision making, such as calculating break even points and analyzing profit scenarios. How can understanding fixed and variable costs improves business decisions? Understanding fixed and variable costs enhances business decision making by allowing managers to accurately analyze cost behavior, predict profitability, and make informed choices. Specifically, it helps in the following ways. First, cost control and planning. Managers can identify which costs are controllable in the short term and which are more fixed, enabling them to develop strategies for cost reduction or optimization. Second, break even analysis. Knowing the distinction allows for precise calculation of the break even point, helping managers determine the sales volume needed to cover costs and achieve profit, thus assessing risk and setting sales targets. Third, pricing decisions. Understanding the nature of costs assists in setting competitive prices that cover variable costs and contribute to fixed costs, ensuring profitability at different sales levels. Fourth, profit planning. By recognizing how costs behave with production volume, managers can forecast profits under various scenarios, evaluate the impact of changes in activity levels, and plan resource allocations accordingly. Fifth, decision on special orders and product mix. When considering accepting special orders or adjusting product offerings, knowledge of variable costs help determine whether additional sales will contribute positively to profit without being overshadowed by fixed costs. And lastly, assessing operating leverage and gearing. Differentiating between fixed and variable costs allows for the analysis of operating gear, indicating how sensitive profit is to changes in sales volume, thus informing risk management. In summary, understanding the distinction between fixed and variable costs equips managers with critical insights to optimize operations, improve profitability, and make strategic short term or long term decisions effectively.
Good day, everyone. My name is Cyrus Trover. Today we will discuss semi-fixed costs, also known as semi-variable costs. These are expenses that have both fixed and variable components. The fixed part remains constant within certain activity levels, while the variable part changes with the level of activity. For instance, consider electricity cost. A business may have a fixed monthly connection charge, which remains the same regardless of usage. However, the additional cost depends on the amount of electricity consumed, making it a variable expense. Similarly, telephone charges often include a fixed rental fee for the line, plus variable charges based on the number of calls made or data used. Salaries with bonuses or overtime are another example. Employees receive a fixed basic salary, but additional earnings may depend on performance, sales, or extra hours worked, introducing a variable component. Lastly, gas or water bills typically have a fixed service charge, with additional costs based on consumption, reflecting the variable nature of these utilities. Understanding semi-fixed costs is crucial for business as they plan and manage their expenses. By recognizing both the fixed and variable components, companies can better predict costs and make informed financial decisions. Let's look into a simplified example of applying the high-low method to estimate semi-fixed costs using a small bakery's electricity expenses. In this scenario, the bakery tracks its electricity cost over 6 months. By identifying the highest and lowest activity levels, which are June with 200 units baked at 2,500 and January with 100 units baked at 2,000 pesos, we can estimate the fixed and variable components of the electricity cost. Step 1. And calculate the variable cost per unit. This is done by subtracting the total cost at the highest and lowest activity levels and dividing by the difference in activity levels. Substituting it to the formula, we will get a variable cost per unit of 5 pesos. Step 2. Determine the fixed cost. Using the variable cost per unit, subtract the total variable cost at either the high or low activity level from the total cost at that level. And using units data, we will get a fixed cost of 1,500 pesos. Lastly, step 3, we can estimate now to the total cost for a different activity level. Let's say 150 units baked in July. Using the formula adding the fixed cost and variable cost, our total cost would be 2,250 pesos for the month of July. By applying the high-low method, the bakery can estimate the electricity cost for any given activity level, aiding in budgeting and financial planning. Now we're exploring the contribution margin, a fundamental measure in business finance. Simply put, it's the amount left from sales after we cover all variable costs like materials and labor. The remainder is what we use to cover our fixed costs, things like rents and salaries, and then turn into profit. Why is this important? Because it let us calculate break-even points and show how profit changes when we adjust prices or sales volumes. It's a powerful tool for managers to test different scenarios, set price smartly, and plan production efficiently. Having clear insights into contribution margin strengthens decision making and drives sustainable profitability. Let's walk through an example to make this concrete. Imagine we sell a product for 40 pesos, but making it cost 25 pesos in variable expenses. That leaves a contribution of 15 pesos per unit. Another way to look at it is percentage terms. 15 pesos is 37.5% of 40 pesos. What does this tells us? It means that for every unit sold, 37.5% of the revenue helps cover fixed expenses and then generates profit. If we sell more units beyond our break-even point, that 15 pesos times number of units becomes profit. These numbers give us the tools to make smart business choices, like how many units we need to sell to break even, or whether we can adjust pricing without losing money. With this clarity, managers can better forecast profits, price strategically, and make decisions that enhance the bottom line.
Hi, my name is Marlon Lim, and at this point, let us discuss the break-even point and the margin of safety. In other words, this is how you find out when your business actually starts making profit and how far you are from losses. The break-even point or BEP is when your total revenue is equal to your total cost. So this means there is no profit yet and also there is no losses. So here are the formulas. BEP in units is equal to fixed cost divided by selling price less variable cost. And BEP in sales is equal to BEP units times the selling price. So this helps you understand the minimum sales you need to avoid losses. Nakakatulong ito sa pagpaplano at pagpepresyo sa negosyo. This helps with planning and pricing in our business. Let's go through an example here. Our selling price is 120 pesos, variable cost is 60 pesos, fixed cost is 12,000 pesos. So again, to get the contribution margin, we have selling price less variable cost, and we will get 60 pesos contribution margin. So the break-even point in units would be 200 units, and the break-even sales in pesos will be 24,000 units. So we need to sell 200 units or earn 24,000 in sales just to break even. So we will look now at the margin of safety or MOS. This tells you how much your sales can fall before you actually start losing money. So to get the MOS, here is the formula. MOS is equal to our expected sales less BEP sales. So to get the MOS in percentage, the formula will be MOS percent is equal to MOS divided by expected sales times 100. So kapag mas mataas ang MOS, your business is safer. In short, the bigger margin, the lower the risk. So here's an example. Our expected sales is 500 units. Our BEP is 429 units. The MOS would be MOS is equal to 500 less 429 units is equal to 71 units. And the MOS percentage is 71 divided by 500 times 100 is equal to 14%. So even if sales drop by 14%, you will still not losing money. So to sum it up, know your break-even point first to track your margin of safety and use these tools to make smart lower risk decisions. Thank you.
Good day, everyone. My name is Roy Tapalya, and I will be discussing about the economist's view of break-even. The economist's view of break-even point as essential sales level where total revenues precisely match total cost, including both fixed and variable expenses, marking the threshold between financial loss and profitability. In reality, cost and revenue lines are often non-linear due to factors such as economies of scale, bulk discount, shortages, or increase of at higher volumes. For example, variable costs per units may decrease at higher production levels because of inefficiency or increase due to shortages or increased raw material costs. Similarly, sales revenue per unit may decline at a higher volume as a firm lower prices recognize the relationship between cost, revenue, and output to attract more buyer. Therefore, economists see the traditional break-even point chart as simplified version, and they understand that the actual cost and revenue tend to be curved rather than straight line. As a result, a true relationship involves considering how economies or these economies of scale influence cost and how market prices strategies affects revenue at a different output levels. This perspective implies that the actual break-even point may vary depending on the nonlinear factors. The economist's perspective, as depicted in Figure 3.12, imagine this graph how much money or company make revenue and how much it spent, which is the cost, and as it's produced more volume of activity. So let us all define the lines is what it's all about. So the flat blue line at the bottom is the money that the company must pay no matter how it produce or sell. Think of it like a rent or a factory insurance, salaries for core staff that don't change with production. The blue line that starts above fixed cost and goes up is the total cost. This is the total money of the company spent to produce its good. It includes both the fixed cost and the variable costs. Costs that change with each unit produced like raw material or production line wages. Why it is curved as S shape. When a company first start producing, it might get more efficient. It might get discount for buying more materials or its workers become faster. So the cost per additional unit might go down, making the total cost curve rise more slowly. This is often called economies of scale. This is the initially flatter like A. The stepper later like B. After a certain point, producing too much can make things less efficient. The company might have to pay overtime, breakdowns more often, quality control, because harder it might struggle to get enough raw material, pushing up cost, so the cost per additional unit goes up, making the total cost curve rise faster. This is often called these economies of scale. The total revenue, which is the purple line that starts from zero and curves up and down, this is the total money that the company earns from selling its product. Initially straight steep, the first step as the company sells, more revenue goes up steadily, usually because they're selling at a set price. Curbing platter, then possibly down to sell a lot more, the company might have lowered its prices. Now, let's talk about the break even part. Though this is not explicitly labeled, the break even point A is where the purple revenue line crosses the blue total cost line from below at this volume of activity the company covers its cost. The second break even or loss point where the purple line crosses the blue total cost line against as volume increases. After this point, the costs are rising fast rather than, meaning the company would rather start losing money again at the very high production. The profit company makes a profit when the total revenue is the total cost, which is the sweet spot in the middle of the graph. The biggest profit would be the vertical distance, even when the purple line and the blue curved line is the largest. Let's proceed to the case studies of Volvo failed to reach its break even during 2013. This case study analyzed Volvo Car Corporation failure to achieve its break-even point in 2013. On the three major core problems, persistent weak market demand and key regions substantial fixed costs increased due to its strategic investment and intensive competitive pressure within the premier automotive segment. The consequences of operating below break-even are explored, including significant financial losses, strained cash flow, and limitation on future strategic growth and product development. The analysis highlights critical financial vulnerabilities and strategic imperatives for automotive manufacturers in navigating dynamic global economic landscape. Introduction. The break-even point, presenting the sales of volume or revenue at which total cost equals total revenue, is a fundamental indicator of financial viability for any businesses. Sustained operation below the break-even point signifies financial losses and undermines long-term sustainability. This case study examines this period several years after its acquisition by Sejan Gili Holding Group was characterized by the confluence of challenging global economic conditions, significant internal strategic shifts, and the inherent complexities of highly competitive automotive industry. By identifying the analyzing three major core problems and their direct consequences, this paper seeks to illuminate the critical financial and strategic challenges faced by the Volvo and other offer insights applicable to the broader manufacturing sector. The background of Volvo Car Corporation. It is a manufacturer renowned for its emphasis on the safety and quality underwent a pivotal ownership change in 2010. When it was acquired by China Geely, this acquisition brought a new capital and renewed focus on global expansion, particularly in emerging markets. However, the years immediately following the acquisitions, including 2013, presented a complex operating environment. The global economy was still recovering from 2008's financial crisis, with particularly weakness persisting in Europe, a traditional cornerstone market for Volvo. Currently, the automotive industry was grappling with intense competition, rapidly evolving technological demands, and the need for significant investment in the new platforms and powertrains. Against this backdrop, Volvo faced the imperative to increase sales volume and manage costs effectively to transition from investment heavy pace to substantial profitability. And now, let's discuss the analysis of core problems contributing to the failure to reach break-even point in 2013 of Volvo Corporation. So Volvo's failures to achieve its break-even point in 2013 can be attributed to three primarily interconnected challenges. The first one is persistent weak market demands, particularly in Europe. A primary driver of companies' inability to reach break-even point is insufficient revenue generation in 2013. European automotive market, a significant traditional sales region for Volvo, continued to struggle with the aftermath of the Eurozone sovereign debt crisis and general economic stagnation. Consumer confidence remains subdued, translating into cautious spending on a large discretionary purchase like new cars. This depressed demand directly suppressed sales volumes below the level required to cover Volvo's substantial cost base. Unlike some competitors who had more diversified global footprints or stronger position in rapidly growing markets like China, at that specific juncture, Volvo reliance on the weak European market created a significant revenue shortfall. The next one is substantial fixed cost increase due to strategic investment in new platforms and technologies. The following Geely acquisitions, Volvo embarked on the ambitious strategy to revitalize its product portfolio and its technological capabilities, including the development of its scalable product architecture and a new range of drive E powertrains. While crucial for long-term competitiveness, initiative necessitated massive investment in research and development, retooling factories, and expanding engineering capabilities. This expenditure significantly inflated Volvo's fixed costs, increasing the required break-even volumes of sales. When these elevated fixed costs were combined with previously mentioned weak market demand, that gap between actual sales and increased break-even threshold widened considerably. The next one is the intense competition and market positioning challenge in the premium segment. Volvo operates with a highly competitive global premium automated market, directly contending with a formidable players such as the BMW, the Mercedes-Benz, and the Audi. These competitors often benefit from greater brand recognitions, larger scale networks, and more extensive model ranges, including popular SUV sedan segments. In 2013, Volvo faced a challenge in generating sufficient in safety might have been perceived as less dynamic or comprehensive compared to the competitors who are aggressively launching new models expanding into highly lucrative subsegments. This limited Volvo's ability to capture the necessary market share to achieve break even. The next is the subsequences or consequences of operating below break even. The first one is the significant financial losses and erosion of capital. The most direct consequences of operating below break even is incurring net financial losses. These losses directly deplete retained earnings and shareholders' equity. In this case, sustained losses necessitate either drawing down cash reserves, increasing debt, or requiring further capital injections from the owner to maintain operation and fund going investment. For Volvo in 2013, these losses absorbed their capital could otherwise be reinvested in growth or used to strengthen its financial position. The next is strained cash flow and operational limitation. Operating a loss signifies that outgoing cash payment exceed incoming cash receipts. This creates significant strain on companies' working capital and overall cash flow. A tight cash position can limit ability to fund day-to-day operation, pay suppliers on time, and or even make necessary short-term investment. The next is epidemics to future strategic growth and product development. Consistent financial losses and strained cash flow directly reduce a company's capacity to fund future growth initiatives. In a capital intensive industry like automotive, sustained profitability is a crucial for reinvesting in research and development for next vehicle, expanding production capacity, establishing new market presence, or pursuing a strategic acquisition. A failure to reach break-even point financially fundamentally limits this critical strategic. And now we'll go to the conclusions and recommendations. Volvo Car Corporation failure to reach its break-even point in 2013 highlights the profound challenges inherent in a capital-intensive industry susceptible to economic fluctuation and intense competition. The confluence of depressed market demand, substantial fixed costs from strategic investment, and a fierce rivalry collectively push Volvo's market demand break-even threshold is beyond achievable sales volume for the year. This resulted in significantly financial losses, strained cash flow, and potential constraint on its ambitious long-term strategic agenda. To mitigate such vulnerabilities and ensure sustainability, and profitability in dynamic market environments, automotive manufacturers, including Volvo, should consider the following strategic recommendation: accelerate global market diversification and regional optimization, while Europe markets were weak, focusing on the rapid expansion and market penetration in high growth like regions in China and North America is critical to offset regional downturns. This involves tailoring products, offerings, and making marketing strategic marketing strategies to specific regional consumers' preference and regulatory environments to maximize revenue potential. Implement agile cost management and invest prioritizations. Given the high fixed costs associated with automotive, and manufacturing companies must develop robust cost control mechanism and prioritize strategic investment with clear, measurable returns. This includes optimizing supply chains, enhancing manufacturing inefficiencies, and ensuring that spending directly translate into a commercial viable and demand product that can swiftly drive revenue. Reinforce brand differentiation and product portfolio. Continuously innovation and compelling product pipeline as essential to cut through intense competition. This means not only developing new technologies but also ensuring that Volvo's unique selling proposition are effectively communicated and resonate with a broader consumer base, especially in bargaining segments like SUVs and electric vehicles. Regularly assessing and adapting the product mix to market demand is crucial for optimizing contribution margins. By proactively addressing these areas, companies can build greater resilience against market volatility, accelerate their journey past the break even threshold, and establish a foundation for sustained profitability and strategic growth.
Hello, it's me again, Desiree Tisea for the quiz time. Motor Music makes a standard car radio, plans to sell 20,000 units next year. The costs are for selling price per radio 60 pesos, for variable cost per radio, materials 20 pesos, labor 14 pesos, other variable costs for 12 pesos, sales administration 3 pesos, and for fixed costs, manufacturing fixed costs 80,000 pesos, and for admin and selling fixed costs 60,000 pesos. A. Calculate the break-even point in units and sales value. And B. Calculate the margin of safety in units and sales value. To calculate the break-even point in units and sales value, step 1 is to calculate the total variable cost per unit. Total variable cost per unit is equals to 20 plus 14 plus 12 plus 3 is equals to 49 pesos. Step 2. Calculate the contribution per unit. Contribution per unit is equals to selling price minus variable cost is equals to 60 minus 49 is equals to 11 pesos. Step 3. Calculate the total fixed cost. Total fixed cost is equals to 80,000 plus 60,000, total of 140 pesos. Step 4. Calculate the break-even point in units. Total fixed cost over contribution per unit is equals to 140,000 over 11, total of 127, 27.27. Rounded to whole units, break-even point is equals to 12,727 units. Step 5. Calculate the break-even sales value. Sales value is equals to break-even point units is multiplied by selling price equals to 12,727 times 60, total of 763,620 pesos. To calculate the margin of safety in units and sales value, step 6 is to plan sales units is equals to 20,000 units. Margin of safety in units is equals to planned sales minus break-even point is equals to 20,000 minus 12,727 equals to total of 7,273 units. Margin of safety in sales value is equals to 7,273 multiply by 60, total of 436,380 pesos. The final answers are: for part, break-even point, units 12,727 units, and total of sales value 763,620. And for margin of safety, 7,273 units, total of sales value 436,380. In conclusion, the cost volume analysis report is a crucial tool for understanding the relationship between cost, volume, and profit within an organization. It identifies cost behaviors, break-even points, and profit targets, providing valuable insights for decision-making and strategic planning. Continuously reviewing and reassessing these elements is essential to adapt to changing market conditions and to ensure sustained success. The insights gained from this report will shape future strategies and drive organizational growth. Again, we are Group 2 and thank you for your time.